That's great. I think two perspectives were put here. One, and both in terms of the margins or the return on investment. I think what Nrinder wanted to point out was the margin for the developers or the financiers of the new build. And then the other point was for the investor. So margins are continuously getting squeezed because of the cost of construction, as Nrinder rightly said, which then leads us to two options. One is either the developers increase the price, and that is subject to being acceptable by the demand side. And then the demand side would think about the yield and the cost of finance. And sure, there might be people like you who would say, even if my mortgage is getting covered, I'm a very long-term investor. So I probably want to see how much I make over 25 years and not over the next 5 years. But where do you think these two would again coincide? I mean, on one side, you've got the cost of finance, which has gone up for development, the cost of construction gone up for new build, which basically means that if developers would still want to have a 25, 30% margin on cost, they would have to increase the prices for selling it to investors. And then we come to the investors who would say, hey, look, I'm willing to put in the 25% deposit, take a mortgage, but my mortgage rates are now 5.5% instead of being 2.5%. So does this make sense? Do you guys think this is going to converge in the next 5 years? Or do you think because of where we are at today, the interest rate and the construction costs being two variables, it would get reflected in the reduction of new capacity being added? Because we just did a research last week, we printed a report, and we saw that in PBSA, especially in the student accommodation market, the number has come down from 34,000 beds being added in 2017-18 to just 12,000 new beds being added in 21-22. And I'm guessing it's because of the macroeconomic conditions we're talking about. So what are your thoughts on these two matters?
I think the interest rates thing is interesting because as we know with a buy-to-let, you can go interest only. So actually the rise isn't going to be massive, you know, from 2.5% to 5%. You know, it's not a massive increase when you're interest only. Yeah, all right, it's noticeable. But in the same way, you know, the real estate market is slowing down, and we see developers, and I've seen developers even sort of just post-COVID, you know, struggling to sell the last 3 or 4 either flats or houses on their development. And you know, buyers in particular that I've seen with some of the people that I'm working with, you know, they're not as interested. There isn't the demand there because they feel that house prices are going too high with the mortgage rates, as you suggest. So something's going to have to change somewhere, and I think it'll be interesting to see what. I don't think I have the answer, but for me personally, and again, as a cash, you go in as a cash buyer, which again I deal with, and then suddenly, you know, you're going to get a cut from the developer anyway, because obviously they stand a really quick sale for them. But also then, you know, that's less of a thing that you have to worry about, because you're still going to get a good return on your investment. And at the moment, safety wise, where would you put your money other than property, you know, as a long-term investment?
What do you think, Nrinder?
So I think if we look historically of where buy-to-let has come from, buy-to-let started probably sort of in the, you know, I've been involved in property for a while, but, you know, buy-to-let started to become sort of mass, you know, in the mid, you know, in the 90s, mid 90s, when there was buy-to-let products being made available. It was predominantly smaller landlords who owned, you know, 1, 2, or 3 units. As we look where we are in 2023, and we look at what impact build to rent is actually having, where blocks are being built and funded and maintained by larger financial institutions. So you could sort of say larger financial institutions have moved into this space with much, much more available cash, and they're trying to do things on scale. Where does that sort of leave sort of smaller landlords who are interested in continuously investing and getting a return on their investment? I look at your question in terms of costs. I can only sort of see costs continuing to increase right now. But I think a lot of these institutional investors, and I could sort of say very much within my business as well, where we develop blocks of flats, but we try and gain scale. So if we are, it's very commonly known, it's going to cost you in terms of the amount of time and effort to build 10 flats as it is to build 20 flats. But what you're gaining from 20 flats is scale, and that's how you control your costs in terms of the build, but more importantly, in the ongoing management of that block as well. So there are some factors to take into account of how do you control costs over a period of time, and obviously with finance also being one of those costs. So it's important to look at the whole picture in terms of where is your return going to come from? What can you control in your return? And that's obviously your costs. With where you have finance, it's great to be able to get into longer term financing products, because the market knows that, you know, the 5-year rates are predicted to be lower than what they are today. But I think it's a cost of doing business in terms of what you need to pay to be able to get into investments right now.
You make a very valid point. I think scale is a very valid point, which does bring down fixed cost drastically. Richard, go ahead. You were saying something.
I was going to say, so on the back of that, and I mean, I've touched on new build because that's where my interest is at the moment. I'm not by any means saying it's the best, you know, the best thing to do for either a small investor or a one-off investor. I think the second-hand market is a much better option for them. It's just I don't have as much knowledge about that and how that's working at the moment. So would you say, sort of on the back of everything, is now actually a good time to invest in properties? Is now a good time to try and increase your portfolio, or however you want to look at it? You know, where actually do you go, you know, to do that?
Well, I would certainly say now is a good time for pretty much everything, because I am a believer of buying in bear markets and selling in bull markets, not the other way around. And I think the last 18 months have been an exceptional opportunity for every asset class, whether it is property, stocks, bonds, commodities. And I think the next 12 months are still going to be probably the best time in this decade. So I think anyone who's got in 22 or 23 is going to be making the most amount of money 10 years from now. Because once things start cooling down, we are back in the competition game. Lenders would be back in competing for rates. Buyers would be again back competing for prices.